Well, hello everyone, and welcome to our medalist and market update at Morningstar. My name is Michael Molseed. I'm head of institutional portfolio management, and I'm joined by Matt Wilkinson, who is the portfolio manager of the medalist series. Just in terms of some housekeeping today, so this session is registered for accreditation, so you'll receive CPD details via email in about a week. We've got a Q&A function, so please enter that through the system. And at the end, please provide feedback via the survey on the webinar so that we can continue to create content that you're interested in and is valuable to you. This session is being recorded, so a recording will be available to attendees following. In terms of the agenda today, we're going to give an overview of where we're at with the Morningstar medalist portfolios. There's been a few changes in the portfolio which we'd like to draw your attention to, certainly accretive additions and some positive changes which we'd like to highlight. And then we'll give a bit of a market overview and backdrop in terms of what we're seeing. I'll hand over to Matt to talk about the portfolios.
Cool. Thanks, Mike. It's good to be back after a little hiatus. Just a background on these portfolios. So multi-manager, multi-asset portfolios, very diverse across all the major risk profiles here. 6 different risk profiles from conservative to all growth. All growth just having a little bit of cash according to the platform requirements, but you can see that they're highly diversified. One thing to note is that there's no alternatives in these portfolios. We're not offering alternatives at this point in the medalist core portfolios, but we do have others that do have alts in them. And these are the portfolios themselves. There's a lot of numbers here, but just so you have them at your fingertips later on, you can see here in terms of there's Australian equities at the top, and then global equities, infrastructure, etc., and then the more defensive asset classes down the bottom. What you can see here is that the portfolios are tilted towards global equities at the expense of Australian equities. Just a minor tilt there. We're slightly underweight infrastructure, about equal weight or slightly overweight global property. They're probably some of the major tilts that are going on across the growth asset sort of side of the portfolios. In the defensive side of the portfolios, we're a little underweight cash, particularly from balanced, moderate and conservative portfolios, and overweight Australian bonds in particular. At the growth defensive end, the target portfolios are at the SAA way. So we're not the balanced portfolio, for instance, is at target weight of 50% growth assets and 50% defensive assets. But I'll let you look at that going forward at your own leisure. The key things I want you to take away from this webinar are that performance absolute returns have been very healthy indeed, and peer relative returns have been strong too. Active management, as many of us would know, has struggled by and large over the last 2 to 3 years, but there has been pockets of good performance. And what we've done is look to the structure of our portfolio to give us and change. We'll talk to changes in the portfolio so that we have greater visibility on the tracking error that it's coming through. And by tracking error, I mean the differences where the portfolio is different to the SAA. So we have sort of strengthened the core satellite approach in that we have, particularly in Australian equities and global equities, core manager that's sort of bounding the portfolio across different styles. It is neither value or growth orientated. And the satellite approach being more of a value manager or growth manager or emerging markets or small caps. And so we've really sort of strengthened that as we've seen the portfolio and in fact markets sort of develop over time over the last couple of years in particular. This enables us to have very certain levers that we can pull when we get conviction through our investment research about what part of the market we particularly like to favour. Recent changes have been, there's been quite a few recent changes. Very recently, there's been Valley Gifford. We've initiated on that. That's been our global growth manager we found an opportunistic time to put that into the portfolios, and we're happy with that. We've lifted our weights into Platypus. That had faced a few headwinds. And then we rebalanced very recently in latter part of July, following the distributions that were made from all the funds. Let's just talk to that timeline of changes in the portfolio. And really, as I said before, we look to strengthen that core satellite approach. We saw GQG, starting from the left here, we saw GQG that has changed their portfolio structure. They went from being quite a growth-orientated manager to being quite a value-orientated manager through 2025, particularly the early part of 25. So we exited that portfolio into that strategy and implemented and initiated on qual. MFS similarly were drifting down the cap ladder, and we initiated on life cycle. Now, they're both managers that we still like, but they weren't playing the role in the portfolio that we wanted them to play. Fidelity was another one that we did exit toward the back half of 2025, and we initiated on Solaris. Slightly different reasons in that Fidelity was again a core manager, but we just had a lot more confidence and then in Solaris, but also the type of portfolios that they were building were more diversified and quite benchmark aware. That was going to help us get that core type of manager and core type of performance profile that we were after. The early part of this year, we talked about Platypus, that we did upweight that, and life cycle as well. Managers that we really like that have underperformed. We think that there's often a good opportunity to upweight those managers in our target portfolios and hopefully get the benefit of a mean reversion in performance. In May 2026 here, it just mentions the implementation of Bally Gifford, initiated on that, and we've made some sort of smaller changes at the margins around qual and life cycle, and also again further uplifting Platypus, and I'll talk to that manager in a moment. So in terms of those big changes, I think it's important to note how that's played out for us. And here we have a little table of the managers that we exited sort of on the left-hand side and the returns of that manager since that exit. And then corresponding to that manager is the strategies that we initiated on and the returns from that manager. So you can see here that GQG has in fact changed its style quite significantly, and has generated a positive return of just over 5%. But we initiated on qual, and since then that's done, almost 25%, so 24.07. So that's been a very good outcome for these portfolios. MFS similar, has done just under 5, whereas life cycle's done almost 11 over the same time period. And Fidelity, in a tougher environment, has underperformed, or has generated negative 2.4, and Solaris was just under 0.5% over that same time period. So those decisions from a decision analysis perspective has worked for us so far. So that's a good sign. And that last line there is the position that we've just recently initiated in May on Bally Gifford. And you can see that the positive return that's contributed to the portfolio since then. So just a little bit of detail on two managers. First of all, Bally Gifford, in the reasons why we initiated on that. And I think it's important for investors to further understand our investment process. And this kind of highlights that. So the portfolios were needing a little bit more growth, and particularly US exposure. We wanted a high quality manager that was rated very strongly. And we wanted a manager that was a long-term investor and would consistently choose the kind of stocks that would meet its investment profile, investment tests. So the style box is on the right-hand side there, and you can see the blue line and in fact the wider blue circle. That's indicating that the Bally Gifford long-term global growth portfolio is very much growth orientated, whereas the benchmark you can see is sitting toward the middle of that style box and is sitting in the blend box. So Valley Gifford is giving us that certain style, that growth style that we were after. It also has a material weight in emerging markets, and we like that area of the market right now. So that's an added benefit that Valley Gifford will give us. Next slide. I talked to Platypus a moment ago, and this chart that you're seeing here is the excess return chart over time, rolling 12-month excess return. And you can see that predominantly, looking from the left to right, it would mostly sit above the zero line, giving us positive excess return. But it's actually had a couple of bouts of negative excess return in more recent times. And it's important when you're conducting manager research that you uncover why that's happened. And we were in very constant or in ongoing conversations with Platypus. We retain our faith in that manager. There was no fundamental reasons for the manager to underperform going forward. And in fact, when we compared similar type strategies in the market, we saw that actually those strategies performed worse than what Platypus had. And so we looked to actually increase our target weight to the Platypus strategy. And you can see that actually that's starting to pay off as the underperformance bottoms and hopefully starts to revert towards that zero line and possibly above. So that's a good outcome for us. It's part of, I guess, the attributes that we offer here in terms of being very close to our managers, understanding their investment processes, how that fits within our whole portfolio, and we adjust our portfolio to fit not only the managers, but also what we see in the market going forward. Just in terms of performance, so that you have the numbers there in front of you. We talked about absolute performance being very strong. The all growth portfolios, averaging or total return annualized is above 11% over 3 years. That's very strong. And in fact, more recent times, all markets have done very well, including fixed income and equities. So that's leading, obviously, the moderate and conservative portfolio to deliver healthy returns for, in a relative sense, given their asset allocation too. So we're happy with that. The June quarter was strong after the first quarter, seeing a certain amount of volatility. Again, that's where we're reaping the benefit of diversification across managers and indeed a mix of underlying securities too. I think the investors overall should be reasonably happy with the diversified portfolio doing as we would like it to do. Thanks, Mike. I'll hand back to you.
Great. Before I turn to market backdrop, there's a few questions that have come in on the webinar, which I think we can address with Matt while we're talking about the portfolios, because there's some good ones. Julian asks, with Valley Gifford, they had a major negative underperformance over the last 12 months, which has pulled down their long-term 10-year return numbers. So maybe can you talk to the selection of that manager relative to others in the universe that you might think of?
So there's a couple of specific reasons why we put managers in the portfolio, and the first one by far is they need to perform a role. It needs to fit within the whole portfolio. We often talk about roles or players playing position in a sport. Well, we have roles in a portfolio so that they can meet and exceed market performance. And it's like a team. And so the Valley Gifford strategy is actually is going to perform our global growth exposure. A couple of things there is that many managers in the Australian market don't actually give you the kind of growth that we needed. And Valley Gifford is one that can be quite aggressive in that area, and we like that. That's why it's actually in the portfolio, but it's at a modest weight. So we haven't dived into that holus bolus, so to speak, but we certainly have a mild weight to Valley Gifford in the portfolio. Now we think you can do as much back testing and measurement as you like, but we think that weight marries well with the other weights across the portfolio. The other thing that we've done is we've invested, we think, at an opportune time. We'd rather invest in Valley Gifford after it's underperformed. We know the kind of stocks that they hold, and they hold those names for a very long period of time. We'd like those names, that style, to have underperformed such that we can capture the mean reversion. Hopefully that's to come. We expect that mean reversion when we have a high quality manager that's rated well by us internally, and in all likelihood, we think that investment process will come back into favour and hopefully generate good returns for investors.
Right. One on tactical asset allocation from Justin asks if the TAA in Medalist is broadly reflected across other Morningstar portfolios, such as through return funds.
Great question. So we like to say that all the portfolios run out of the Morningstar Investment Management team are looking in the same direction, but we're playing in slightly different sandpits. And by that, we mean our investment guidelines are a bit different, and how we execute our investment ideas is a bit different. The Medalist portfolios are multi-manager, multi-asset, with an asset allocation range of plus or minus 10%. In reality, you don't go quite near that. In fact, we're probably plus or minus 5 is typically the extent of the dynamic tilting, I guess. And some of the multi-asset portfolios that are run out of from other members of our team are much more have wider ranges there. So we look in the same direction. We're overweight emerging markets. I think we're overweight healthcare, for instance, and they're consistent in the way our whole team has a view on the market at the moment.
And then another one on asset allocation, just our weighting to infrastructure. Question as to why it's relatively low. I think part of that's our SAA and part of it's a tactical decision as well. So could you talk to that?
Yeah. So the SAA is based on our long-term assessment of valuations and of returns across all asset classes. So the SAA is set, say, for instance, it might be 5% in all growth portfolio, but we have currently, our shorter view on that asset class is that it's overvalued. And so we're just taking a minor DAA tilt, a minor tactical tilt there to see that hopefully that valuation revert. We think it's a little bit overvalued. There's been some very strong performances out of that asset class. So that's why we're underweight that.
Okay, thanks, Matt. Good questions there. Thanks. Please send more through if you have them, and we can cover them at the end. In terms of market backdrop, I think everybody's fairly familiar with the performance of global equities over the past couple of years. Certainly, it's been very concentrated, driven by that AI thematic, the hyperscaler names. I think more recently, what we've seen is a little bit of a change in the contributors, and probably even a narrower focus. And this has driven very strong benchmark returns, but you haven't necessarily seen that being reflected in many active manager returns, because as you're taking active positions away from the benchmark, if you miss just a few names, it can impact your relative performance significantly. So this chart is a waterfall chart showing that of the global equity returns, which of around 17%, about 10% of those returns were made up of just 10 names. And Apple's in there. That's a usual suspect, very large market cap. But if you move across, a stock like Micron was 127 basis points to the index return. Now that's a very small company in terms of benchmark weight. So few managers would hold that, and that SK Hynix, for example, AMD, they're relatively small benchmark names, but they've had phenomenal performance, like hundreds and hundreds of percent return, which has driven the market returns. But you would have not many managers have owned those names, so that's why we're seeing a bit of a dispersion. And we're also seeing a change in the contributors. Now, in what we're hopeful of seeing is, as the economic activity and market strength globally, which we are seeing out of reporting season in the US currently. About 86% of companies have beaten earnings expectations. As you see that breadth of strength in earnings, you'll see a breadth in contributors to market performance. So you'll potentially see a more fertile environment for active managers going forward. That will certainly help drive some of the mean reversion that we've seen where we've had some big underperformance of active managers. This is just a little bit of an overview of asset class returns over the last 12 months. So as Matt said, all asset classes have been positive, which is somewhat unusual. Usually bonds would trade inversely to equities, but everything's strong. So that's driven strong absolute returns across all the risk profiles in our portfolios, which is good, great for investors. You can see that big difference between global equities, the second line down, blue bar in 12 months, and Australian shares. So yeah, the powerhouse of the returns has been from global equities. Our strategic asset allocation has like a structural higher weighting to global equities, which has been positive for total returns in the portfolios. And we've also had a slight tilt into global equities over and above that over the past 12 months, which we've tightened up slightly most recently, but certainly the portfolios have benefited from that. Aussie shares now, we're going through reporting season. Certainly, we're going through a little bit of a period of strength and kind of that mean reversion. The market's underperformed. We're still early days in terms of reporting season. It's pleasing to see some of the technology names like car sales that have been sold off significantly on the SaaSpocalypse trade in the first quarter post pretty good results and had a good rebound off the back of that. So it's really as the fear of AI disruption impacted the market in the first half. What we're hoping to see is just companies continuing to deliver earnings, particularly software companies, and then you get a positive re-rating. And for a manager like Platypus, as Matt mentioned earlier, they do have some exposure to those software names that have been sold off. That was partly the driver of their underperformance over the past 6 months. We think there's a bit of a catch-up trade for them to recover that underperformance as the earnings come through for those companies. Just in terms of equity market returns over the past 12 months, US equities has continued to be strong, but it has been outshone by some other regions, in particular emerging markets down the bottom. That was certainly the strongest area, and Korea being the strongest performer. This is the year to 30 June. So as I said before, driven by some small chip maker names with very strong performance. Korea is a very concentrated market. It's a very small part of the global index, but if you'd been long that, you would have done well. If you don't own it, that would have been a headwind to performance. And then you've seen a lot of volatility in those names as well, as it's been somewhat of fast money sort of moving in and out of that sector. Now, we probably 4 months ago, all the talk would have been about macroeconomics and geopolitical tensions. Fascinating to see that the market's really looking past the shock and risk of the Iran war. So even though oil prices remain elevated, Strait of Hormuz remains closed as we speak, I believe. That can change on a daily basis. The market's really looking through that on the expectation that there will be a resolution, and the inflation shock of higher oil prices would unwind quite quickly. We saw that when they reached a memorandum of understanding a few weeks ago. The oil price fell quite quickly, partly because there's been a lot of supply side response to the Strait of Hormuz closing, certainly strategic reserves being released and other production ramped up. So that has meant that structurally, the equilibrium price of oil will be a lot lower than where it is. So that would be very positive. If we see a resolution, oil price will drop. That will ease a lot of inflation pressure, but we're not there yet. So there's a lot of uncertainty in the market, but I'd say that the equity markets are taking a glass half full approach at the moment. This chart just shows, again, the commentary around, you've got the traditional Mag 7 that had been driving markets up to about a year ago. And in the last 12 months, those smaller chip maker and semiconductors have sort of picked up the mantle and driven the markets and being an even smaller subset of the benchmark. So this is partly the broadening of that AI trade. And you could see in the most recent results in the US, you're starting to see a bit of skepticism with the capex that's been spent. If you're a company with high AI capex and not generating a significant return from that yet, those stocks have fallen. So Meta being the prime example of that, still spending a lot of money on their AI build out, but yet to see the benefits. And contrast that with a company like Microsoft that really saw a strong tick up in the revenue of their services businesses, which is really an AI beneficiary. So Microsoft and Amazon had really good share price reactions on their results, whereas Meta fell, and SpaceX as well just reported their inaugural result, and their capex was a little bit higher than expected too, going all out on that AI infrastructure build. So there's starting to be some question marks over how sustainable that spend is. But all that money is going downstream into the infrastructure, into the picks and shovels type businesses, so that the NVIDIAs, the Microns, etc. in the market. So as that money gets spent, you're seeing very strong earnings there. On the chip making side, there is supply constraints. So as that demand pushes through, it's pushing prices up, which is very positive for these stocks in the near term. And you're also seeing a broadening of that spend out across the economy with infrastructure spend, building and whatnot. So that is driving a fair bit of US GDP growth. Now, $64 million question is it a bubble? I think that's another question that we had prior to this webinar. And if it unwinds, is there a big risk in the market? Now, yes, valuations are elevated. That is a risk, and there's certainly a lot of circular deals in the market which we're monitoring. And up to this date, the hyperscalers have been spending capex out of their strong free cash flow. As they're starting to use more debt, that is more of a risk. Using leverage to spend, they're definitely going to have to see that return coming sooner rather than later. But undeniably, there is strong demand for AI services, and you can see that with the revenue run rates out of firms like Anthropic, which is private, but they're sort of running at about a $50 billion revenue run rate as at June, forecast to increase to about $100 billion by the end of the year. So we're in that revenue ramp up profile, and if that continues, that can certainly lead to decent return on invested capital from this AI capex, but we're not there yet in terms of seeing hard evidence of it. So there is risk both ways, but certainly it's not all negative on that trade. We prefer to invest in areas where we think there is a bit more margin of safety. So while portfolio does have some exposure to growth names through Bally Gifford, we've also got broader exposure to value names through like Barrow Hanley's our value manager, and our core managers tend to have a bit more dispersion. So what we like to see in our portfolios is those returns that can be driven by a diverse set of factors and styles, not just an all-in trade on one particular thing. So we think that's how you can mitigate the risk of one particular risk in the economy being how our capexes have a diverse contribution of return drivers. A little bit on the macro. So in inflation, that's still high. We've got the RBA meeting today. I think the market expectations is they're likely to stay on hold and adopt a wait and see approach. Certainly, the consumer in Australia is feeling the pinch of higher interest rates. You've also had the policy changes of the government, which is leading to a slowdown in investor demand for housing. We saw that Westpac's result the other day. They're seeing lower mortgage applications. So the RBA is going to be looking at the impact of that coming through on housing, and that's also going to impact consumer sentiment. So there's potentially headwinds domestically in that area. And this chart just shows that while through 2020 we had a really high savings buffer from COVID, that savings buffer has well and truly been exhausted. We're starting to see more consumer reliance on credit. So there's going to be a lot more sensitivity to interest rates. So that transmission mechanism of the RBA rate rises that we've seen to date is likely to be more impactful on the economy and result in the slowdown that they're looking for. So, but there's probably a little bit to play out in terms of the next couple of quarters, if they are truly on hold or if there's another rate rise that's required. That's broadly the market update. We'll just see if there's any additional questions through.
No, there's just one here we had come through earlier about our positioning going forward in the next phase of markets. And this is probably worth saying that we were always looking forward. That's why we invest in managers that we think are going to outperform in a portfolio sense. Going forward, we're maintaining a diverse set of factor exposures, as Mike said, manager exposures across lots of stocks and asset classes. And we think that helps us look through various economic, short-term cycles, various other shocks, things like that, so that investors can stay the long term and reap the benefits of long-term investing, which we know works well.
Right. Well, Morningstar Medalist is available on all the major platforms, as you can see on screen, and our friendly salespeople are also on screen. So if you would like to reach out for any more information, please get in contact. Cool. Thanks very much.
Thank you.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.